Most people think once you've saved $1 million, you've made it. Josh didn't see it that way. $1 million sitting in a savings account isn't working, it's just waiting. And waiting has a cost. So he asked himself a simple question. Could a $1 million dividend portfolio generate enough income to actually replace a salary? In this video, we'll watch Josh build the whole thing from scratch. We'll see how he filters and picks every stock, how he structures the portfolio so income lands every single month, and what those payments actually look like once they start coming in. And at the end, I'll show you how Josh could turn that $1 million into a $40 million portfolio, paying over $150,000 in dividend income every single month. To understand how and why this works, you first need to understand why Josh started here in the first place. Here's something most people never stop to think about. Your savings account is not keeping you safe. It feels safe. The number doesn't drop. The balance sits there, and the bank sends you a small interest payment every few months. But right now, the national average savings account rate sits at just 0.39%. Inflation is running at 2.4%. That is a gap of over 2%, and every single year that gap exists, your money is buying less than it did before. Think about what that means with $1 million. At 0.39%, your savings account pays you $3,900 a year. But inflation, at 2.4%, is quietly erasing $24,000 of purchasing power over that same period. You're not losing money on paper, but in real terms, you're down over 20 grand every single year without doing anything wrong, without a single red candle on a chart. That's exactly what Josh sees, and that's what leads him to dividends. Here's how they work. When you own shares in a company that pays dividends, that company sends you a cut of its profits on a regular schedule. Not because the stock went up, not because you sold anything, just because you own it. The payment shows up whether the market is having a great week or a terrible one. Now, when those payments start landing, you've got a choice. You can use them for whatever you want, a bill, a grocery run, a holiday, or you can put them straight back to work and start a compounding cycle that builds on itself every single quarter. We'll get into exactly what that looks like later in the video. But before any of that happens, Josh needs to make sure he's picking the right stocks in the first place, and that means having the right filters. Because picking dividend stocks randomly is just as risky as picking any other stock randomly. A high number on a yield screen doesn't mean the income is safe. The first thing Josh looks for is stability. Companies with long track records of steady earnings. Businesses that kept paying through recessions, rate hikes, and market downturns. If they've held up before, there's a good reason to think they'll hold up again. The second filter is dividend history. Not just companies that pay, companies that keep paying and raise their payouts year after year. That automatic growth means Josh's income climbs over time without him adding a single dollar. Third is the payout ratio. This tells you what percentage of a company's profits are being paid out as dividends. Josh keeps that number generally below 60%. Anything higher and the dividend starts looking fragile rather than reliable. Fourth is diversification. Spreading across different sectors means one bad industry doesn't drag the whole income stream down with it. And fifth is the payout schedule. Mixing monthly and quarterly payers means the income doesn't all bunch up in the same months or weeks. It smooths out into something that actually feels like a regular income. Now here's the other side of that, the mistakes that catch most people out. The biggest one is chasing high yields. If a dividend looks too good, the market is usually telling you something, that there's doubt around whether the company can actually sustain it. That's called the yield trap, and it's caught more investors than almost anything else. The second mistake is putting too much into one sector. If every stock you own sits in the same industry, one bad cycle hits everything at once. And the third is taking dividends out as cash too early. Every dollar you spend is a dollar that stops compounding. That choice, spend it or reinvest it, is what separates a portfolio that stays flat from one that keeps growing. With those filters in place and the mistakes mapped out, Josh is ready to actually build the thing, and the first decision is how to structure it. So here's how Josh structures it. $1 million, split equally across 10 positions. Each stock gets exactly $100,000, 10% of the total. No single holding can dominate the results, and no single bad quarter can derail the income. Everything pulls its weight equally. Those 10 positions fall into 4 categories, and each one has a specific job to do. Josh starts with REITs, real estate investment trusts. By law, REITs have to pay out the majority of their taxable income to shareholders, which produces some of the highest and most consistent yields you'll find anywhere. He includes a monthly paying REIT here specifically to anchor the income. While most stocks pay quarterly, this one shows up every single month. Next, Josh picks his growth-oriented dividend stocks. Smaller yields right now, but these companies have been raising their payouts year after year for decades. Inflation keeps moving. A bond pays a fixed rate and stays there. Dividend growers keep climbing, which is exactly why Josh picks them over bonds or cash. Then he adds a dividend ETF. One fund, dozens of high-quality dividend payers inside it. Josh uses this slot to keep the portfolio diversified without having to pick every single stock himself, steady and broad when the market gets choppy. And finally, the blue-chip dividend stocks, large established companies whose products get bought in every type of economy. Many of them have raised their dividends every single year for decades straight, rain or shine. So that's the fourth category structure. Next, I'll show you Josh's stocks and what dividends they pay starting in year 1. And by the end, I'll show you how his portfolio in the long run could turn $1 million into over a $40 million portfolio, paying over $150,000 in monthly dividend income. But first, let's see exactly which stocks Josh puts into his 4 categories. The REIT position goes to Realty Income Corp., ticker O, yielding 5%. Realty Income leases properties to high-quality tenants across hundreds of locations, and it's got one of the most consistent payout histories in the market. But the real reason Josh picks it is that it pays monthly. Every other stock in this portfolio pays quarterly. Realty Income shows up every single month without fail, which keeps the income flowing steadily between those quarterly payments. For his growth-oriented stocks, Josh picks 3. First is Air Products and Chemicals, ticker APD, yielding 2.66%. It supplies essential industrial gases to energy, manufacturing, and technology companies globally, and its dividend has been growing consistently for decades. Then there's Nexstar Media Group, ticker NXST, yielding 2.93%, one of the largest TV broadcasting companies in the US, with strong recurring revenues that support a growing payout. And rounding out this category is Federal Agricultural Mortgage Core Class C, ticker AGM, yielding 3.95%. It finances rural and agricultural businesses across America, and its dividend growth track record stands out even among dedicated dividend growers. The ETF slot of the portfolio goes to the Schwab US Dividend Equity ETF, ticker SCHD, yielding 3.35%. Before any company gets into this fund, it has to pass strict screens for financial strength, sustainable payout ratios, and consistent cash flow. That process cuts out the weaker names and leaves a concentrated basket of high-quality dividend payers across multiple sectors. This is the slot that keeps the whole portfolio grounded. And finally, the blue chips. Josh goes with 5 here: Procter & Gamble, Johnson & Johnson, PepsiCo, Black Hills Corp., and AbbVie. These are the kind of companies whose products you use without thinking about it. The toothpaste, the medicine, the snacks, the electricity. They've been paying and raising their dividends for decades because the demand for what they sell never really goes away. PG yields 2.75%, J&J yields 2.16%, PEP yields 3.57%, BKH yields 3.79%, and ABBV yields 3.01%. So what does all of this actually pay? Here's how the income lands throughout the year. Dividend payments don't arrive in equal slices every month. They follow a quarterly cycle, and once you see the pattern, it starts to feel like a proper income schedule. January, April, July, and October are the first group. Realty Income opens each of these months with its $417. Then Procter & Gamble adds $688. AbbVie chips in $745, and Air Products and Chemicals brings in $655. Those 4 months each land at $2,504. February, May, August, and November are the second group. Realty Income's $417 shows up again. Nexstar adds $733. Black Hills brings in $948, and Johnson & Johnson contributes $543. Those 4 months each come in at $2,639. Then March, June, September, and December, the strongest months of the cycle, Realty Income pays its $417 as always. Federal Agricultural Mortgage adds $988. SCHD brings in $838, and PepsiCo contributes $885. Those 4 months each land at $3,127. Add it all up across the full year, and this portfolio generates $33,080 in dividend income in year 1. That's an average of $2,757 every single month, landing on a schedule without selling a single share. Now, $2,757 a month is real money. It covers bills, groceries, a car payment, and still leaves some left over. But here's the thing, year 1 was never the point. The real question is what happens when Josh takes every single one of those payments and puts them straight back to work. And that's exactly what we're about to look at. So here's where it gets interesting. Before Josh runs the projections, he needs 3 numbers, and the first one is the portfolio yield. Because every stock gets exactly the same weight, 10% each, a simple average is all you need. No complicated weighting, no adjustments. Just add up all 10 yields and divide by 10. That's it. Realty income at 5%, NXST at 3%, AGM at 3.97%. Add all 10 together, divide by 10, and the portfolio lands at a 3.33% starting yield. Same process for the other 2 numbers. Add up the dividend growth rate for all 10 stocks, divide by 10, 10.86% a year over the past decade. Do the same for share price appreciation, 9.11% a year. 3 numbers, a 3.33% starting yield, 10.86% dividend growth rate, and 9.11% share price appreciation. That's the engine. Now the only question is whether Josh spends the dividends or reinvests them, because that one decision changes everything about where this portfolio ends up. Let's start with DRIP turned off. Remember earlier when we talked about that choice, spend the dividends or put them straight back to work? DRIP off means Josh takes every payment as cash and spends it. The portfolio would still grow through share price appreciation, but that's the only engine running. In year 1, the portfolio is projected to pay $33,280 in dividends. Now, even with every payment taken as cash, the portfolio value would still grow through share price appreciation. And as that base gets bigger, so does the dividend income it generates. That's why the numbers keep climbing. Projected at $85,295 a year by year 10, $242,707 by year 20, and by year 30, it could be paying $690,622 a year, or $57,552 every single month. At that point, Josh's dividend income alone could cover housing, healthcare, and daily living costs without selling a single share. And because these are qualified dividends, they would be taxed at a lower rate than regular income, so the actual take-home is better than the headline number suggests. The portfolio value would follow the same upward path. After year 1, it's projected at $1,091,110, valued at $2,391,582 by year 10, $5,719,667 by year 20, and by year 30, the portfolio could be worth $13,679,055. That's what spending every dividend produces. Now, here's what happens when Josh reinvests every single one of them instead. With DRIP turned on, every dividend payment automatically purchases more shares. Those shares generate more dividends. Those dividends buy more shares. The cycle runs continuously, and the difference it creates over time is staggering. And because the portfolio base is now growing from 2 directions at once, share price appreciation and reinvested dividends, the income it generates grows faster too. In year 1, the portfolio is projected to pay $33,280 in dividends, same starting point as before. But from here, the trajectory looks completely different. By year 10, it could be generating $113,973 a year. By year 20, that figure is projected at $473,688. And by year 30, the portfolio could be paying over $2 million in annual dividend income, or $176,010 every single month. The portfolio value follows the same curve. After year 1, it would sit at $1,124,390. By year 10, it's projected at $3,309,636. By year 20, it could reach $11,636,666. And by year 30, the portfolio would be valued at $43,946,505. Now, let's put both versions side by side and see exactly what that one decision actually costs. Start with the portfolio value. At year 1, both versions are almost identical, 1.12 mil with DRIP on against 1.09 mil with DRIP off. Barely a difference. But look at what happens as the years stack up. By year 10, DRIP on is already pulling ahead at 3.31 million against 2.39 million, By year 20, the gap is impossible to close, 11.64 million against 5.72 million. And by year 30, you're looking at 43.95 million against 13.68 million. That's a difference of over $30 million. The dividend income tells the same story. Year 1, they're identical, $33K either way. By year 10, Drip On is generating $114K a year against $85K. By year 20, it's $474K against $243K. And by year 30, Drip On is paying $2.11 million a year against $691K with Drip Off. That's over $1.4 million more in annual income every single year just from reinvesting. And when you break that down monthly, $176K a month with Drip On against $57K with Drip Off, both numbers could cover a comfortable retirement, but one of them could cover it 3 times over. The only variable in those charts is what Josh did with the dividends every time they landed. If you want to see what $25 a week can do with the same strategy, but with a portfolio built to hit $1.6 million and pay over $5 grand a month in dividends, click the video on screen right now.